Well, we are back for another episode of the Me and Money podcast. And today, since we're early on in the year and people are still probably all excited about their resolutions and maybe making this year a little bit better of a financial year, maybe less stressful, we're going to talk about one of the biggest questions I get from some of my younger clients, credit scores and why they're important. So that's what we're going to cover in today's episode. And Elliott, why don't you just start us off? Like, what is a credit score? And what is it used for? Why does it
Yeah,
matter?
yeah. Well, Matt, why don't I throw this back to you for a second? I mean, you raised the question, why is a credit score important? Maybe we talk about that first.
Yeah, let's go. Let's go. Take a shot at it, Elliot.
I, for me, I think the simplest explanation I can come up with is it's a number assigned to your credit worthiness, or another way to say that is what's your ability or historical ability to pay back loans that you take on.
Yeah, I think that's great. And I mean, it's important too, right? Because if you have a higher credit score, it's going to be easier to get access to new money or new financing, right? Whether it's for a car or a house, and it's also going to make it cheaper potentially, right? Because if you have a higher credit worthiness or you're better at paying back your debts and you have a higher capacity to pay back your debts, it's less risky to whoever's lending you money, right? So they don't have to charge you as much. So that's certainly a big reason too why it's important.
And it can make a big difference. I mean, anecdotally, I've shared in the past when we were applying for a mortgage and we were buying our house, our credit scores were off by literally a single point, and we ended up getting a slightly higher rate because of that. We went with someone who had slightly higher underwriting standards. So normally this would be a certain rate under any circumstance, but in this case, it ended up being a little bit higher. And I don't remember the exact figure, but I think it was like 20 or $30 a month. So you can imagine if you're not focusing on this, or you close an old account, which might hurt your credit score. We'll talk a little bit more about that. It can really end up costing you a fair amount of money. If we think about a 30-year mortgage and you get a higher interest rate, it's a lot of additional interest potentially.
Yeah, or it just might mean you're not able to do what you want to do. I actually had a prospect last year, and I think this is still an ongoing saga, so I don't have the answer to what finally shook out, but they were looking to purchase a new home in retirement, and the husband hadn't had any credit history, and they're really struggling to get a loan now in retirement to go buy a house, even though they have hundreds of thousands of dollars in IRAs and cash and their current property value. And it can just be a really tricky system to navigate if you don't take care of it. So I don't think it should be like the end all be all, like you need to have the top credit score,
Yeah.
but it certainly can make life really annoying and complicated, unnecessarily so for sure.
Yeah. And I think it's important to know that as we talk about credit scores today, there is not a singular credit score out there. There are different types of credit scores. So if you look up, FICO is a common one that's out there, but even within FICO, there's different levels of that, like a FICO 8 or a FICO 7 and other different scores out there that different credit card companies might use a different one. If you're applying for an auto loan, they might use a different type of credit score or a mortgage. So just know that if you look up and you see a certain credit score, or you do one of those free ones, you might see a Vantage score. It's really important to know that that's not the end all be all. And your credit score might actually be off by that by 20, 30, or even more points. So just keep that in mind as we talk about credit scores.
Yeah, yeah. And a big thing too, like I know it, I get those alerts from Credit Karma all the time. Like, oh, this changed. I feel like it's one of those things, it's almost like investments. Like you should pay attention to it, but maybe less so if you don't want to take on new debt, don't plan on taking on new debt. I know the plan can change, but it's one of those things where I don't think you need to be checking it like monthly or weekly. There are some reasons, which we'll talk about later, why we might want to do that, but it's not necessarily something you need to be tracking all the time. Would you agree with that, Elliot?
Yeah, it's not something I track regularly, but I do enjoy when I apply for new debt, getting the form in the mail that says, "Hey, you applied for debt. Here is your credit score." So that way, and what I do is I just save a PDF of that, so I have a reference point in time.
Yeah, yeah, absolutely. Well, yeah, I mean, we talked about why it's important, so why don't we, jump in a little bit? Maybe there's some people out there who have a great credit score and they're looking to maintain that, or maybe some folks who are looking to improve their credit score, some things to think about. So why don't we just start with breaking down the five major categories that go into the credit score, right? And so that would be your length of the account history, right? So how long you've had the credit, your timeliness of payments. So have you made payments on time or had late payments can certainly impact that. How much total credit you have access to and how much of that you've used, which they call the credit utilization. And then the other two, Elliot, can you, I just can't always remember those last two. What are those last two?
You phrase these a little bit differently than I would. So I would say new credit is the last one maybe. So if I were to summarize this, it'd be payment history, amounts owed, length of credit history, new credit, credit mix.
There you go.
Those are the five. And maybe we start talking about each one in a little more detail and things that to keep in mind as we think about that.
Yeah. Yeah. Why don't we start with the first one? Just like,
Yes. So
yeah, go ahead.
payment history, I think that's a good one to go over because if we're talking about FICO score, payment history makes up 35% of your credit score. And key there is really, did you pay stuff on time? That's really the main category there. If you don't, it's going to ding you a lot.
Yeah, yeah, absolutely. And not only that, but if you have late payments on loans or credit cards, right, you usually get hit with a late fee, which is going to add to that balance, or just make it accrue interest even faster. Yeah, and of course, it takes a hit to the credit score. So
And
it's
by major hit, I mean, I think it's important for people to keep in mind how vital this is. I've heard stories online of people who had a really good credit history, miss a payment, and their score drops by more than 100 points, which, if we go back to the mortgage example, could be the difference between a good rate and a bad rate.
yeah, yeah, and I have heard stories where sometimes you can get those, kind of moved or expunged from your record if like it was an honest mistake, right? Like
Yeah.
maybe you just forgot to turn on auto pay, or maybe you switched your bank account and the auto pay didn't process properly or something like that. So but also with that too, not that we're encouraging like keeping revolving balances on credit cards or anything, right? But in order to hit that payment history, you really only need to make like the minimum payment, right? You don't need to pay off the full balance. So if you are in a really tight bind and it's one of those situations where maybe you have like a 0% APR card, or you're okay taking the hit for whatever reason on paying the credit card interest, that minimum payment is what's going to help satisfy that payment history.
Yeah. Good note there. Should we
Yeah.
move on to amounts owed?
Yeah. I mean, that's pretty simple, isn't it?
For the
So
most
how
part.
how much money you owe on the credit card, right? I guess where do you want to go with that? You said mostly simple.
Yeah, I would say how much also that you're using relative to your available balance. Like, let's say you have a credit card where you get a $20,000 limit. How much of that are you actually using? And the tip that I always like to give folks is, let's go with that $20,000 example. If you spend $10,000 in a month, you don't have to wait until the statement balance to then say, hey, I'm using half of my credit or a 50% credit utilization. You could pay that credit card off in the middle of the month before the whole amount gets reported. And that can be helpful because 50%, although it doesn't seem like very much in the eyes of the credit bureaucracy and the history of that, it is quite a bit. Most of them suggest a 10 or 20% credit utilization ratio, or keeping it even below that to show that you're a better, more responsible, I'm using air quotes there, borrower, even if you were to pay it off.
Yeah, absolutely. And I think we'll put a pin in that one for right now, but we're definitely going to talk about that when we come back to like opening new accounts or closing new accounts, like how that impacts the credit. But on the topic of opening new accounts, account inquiry or credit inquiry, and I guess could you paint some context? Because this is one I feel like there's a lot of misconception around, but like what's the difference between like a soft inquiry and a hard inquiry on your credit?
My understanding is a soft inquiry is not going to ding your credit. It's sort of like hey, we're just kind of going to look at this generally, see how things are. Would you actually qualify? Hard credit inquiry, we're actually going into your credit report. We're making a file on that. That is going to most likely ding your credit score a little bit because you are applying for a loan in that case.
Yeah, and a lot of the times when you hear soft inquiry, like it's generally marketed or phrased as a pre-approval process, right? Where they're doing some of their initial underwriting criteria, like how much, roughly do you make, like what are your monthly debt obligations? Like they have some of that information to help them understand, like, hey, do you actually have the capacity to take on either a new account or, in the case of a mortgage, right? Like, how much can you even afford to pay on a mortgage, or how much can you be approved for, so they don't, create a hard inquiry that's going to show that you got declined for credit, right?
Yeah.
Yeah.
And I would say like there are simulators online, but generally people will say a new credit inquiry or a hard inquiry results in maybe somewhere between 5 and 15 points off your credit score, and it will often bounce back within 3 months, give or take. It's not perfect. Everybody's a little bit different. If you don't have a lot of credit history, that might ding you a little bit more, and it may take a little bit longer. I did a simulator online for mine, and it said it would drop 7 points for a certain credit limit. So that just gives you an idea of how that can be impacted.
Yeah, and of note on, new credit or not much credit history, a lot of credit card issuers have actually started to offer some of those securitized or, down payment credit cards, where you pay some amount, usually it's like $100 or $200, that you put towards that card to start, and then they kind of have, a base of money there to at least help you spend and start to build on a credit card. That just reduces some of the risk on their end. So for those of you who might be out there listening to this, like, hey, I don't even have a credit card. Like, I don't know, or none of this really matters for me. And if you're having trouble getting a credit card, that can be a really good way to go start.
Yeah. Should we talk about length of credit history next?
Yeah, I think this is an interesting one. Just especially with my clients being quite a bit younger than I would say your average client. A lot of them are like, how the heck do I get into the top credit score bracket? And a lot of it has to do with time, just like a lot of the tried and true principles of personal finance, right, Elliott?
Yeah.
Yeah. And so, I mean, it's one of those things where, especially if you're just getting started out, you're not going to be able to achieve like the maximum credit score. And it might even be challenging to get up into that excellent or top category for a while, just because you're not going to have length of credit history. And typically they look at this as an average length of credit history. So if you're not the person just getting started out and you have a ton of accounts, if some of those accounts are older and some are newer, it's not necessarily going to reflect what your oldest credit card is. That'll certainly help towards payments made and payment history, but it's going to actually drag down that average credit age if you do have some newer cards or newer accounts on that list. What was that like for you, Elliott, getting a mortgage?
Yeah, I mean, I want to spend a little bit of time talking about this, Matt, because you hit it that if, let's say, you have a really old credit card and then you open 4 new ones, that's going to sway your average to not be very long at that point. Same thing if you have a mortgage or you continually refinance. I know I've refinanced in the past, and it just kept resetting that rate and making the average credit age not very long. I had an older credit card, a semi-new one, and then a mortgage that just kept essentially turning over. So that's something to keep in mind, that can hurt you if you're opening quite a few new credit and you don't have a lot of other established accounts. If you're refinancing, anytime that you get a new loan, it's going to probably bring down that length of credit history. So that's just something to keep in mind, that you may want to space it out. You may want to open a few and just let it be there to sort of allow them to mature. The other thing to keep in mind is not to close your oldest account. I always give the example that if you have like a 10-year credit card and a 1-year credit card, they have been open that long, and then you close the 10-year, well, you took your average age from, call it 4.5, 5 years or so, down to 1 now. So that can significantly hurt you, even if it's a credit card you never use. There's good reason to potentially keep that open.
Yeah. And, sometimes you do have to make sure you pull those out every 3 months or so. Like, I have some from back in college that I never use. And it's like, I'll get a notice once or twice a year where it's like, oh, you haven't used your credit card in 120 days. Like, you got to use it. Otherwise, we're going to close it. So just go buy a soda, or go buy a cup of coffee somewhere, and like keep that thing open for sure.
Yeah.
Yeah.
Uh,
Yeah. Well, one other thing while we're talking about, like, I guess just, being able to get new money or new debt or new loans. I know you had mentioned when you were going through your mortgage underwriting process that they sometimes look at your income too, right? So it could be completely, well, they always look at your income, but
I was going
I
to
guess
say.
I guess they look at income differently depending on what stage of your life you're in too, right? And so credit score may not even matter all the time.
Yeah, you talking for like self-employed people?
Oh, that, or I know like with Molly being in school, right? Like that wasn't that a partial challenge to the process as well?
Having loans. So I would say if you have
Yeah.
any extra thing that can be a problem, whether it's self-employment, showing stable income, 2 years of self-employment, how they handle student loans, even if you're on a student loan repayment schedule, that can be an issue. And sometimes you have to work with the underwriter for them to really understand, because if it's outside sort of just the normal W-2 standard loan repayment, sometimes they struggle with that.
Yeah. Yeah. So again, like it's the reason I wanted to bring that up is, the credit score is certainly one component of it, but it's not going to guarantee like make it where you get approved for
Oh
any
yeah,
loan
you got to
that
have
you
the
want.
income to
Yeah.
support the loan that you're taking on, for sure.
Yeah. So it's not everything, but credit score is important for sure.
Definitely.
But yeah, why don't we go into, some strategies or just things to think about.
Real
Oh,
quick, I want to go through credit mix because it's the
oh,
final 10% of it.
thanks for keeping me accountable there,
Yep,
Elliot.
yep. So on this one, I think this is a short one, but what's really important to keep in mind is that and again, this is the credit system. I'm not saying this is the perfect way to do things. And much of this we all have frustration with, myself included. But credit mix, they want to see different types of loans, which sounds counterintuitive, right? I want all my credit and my debt paid off. That's a good thing. But in the eyes of the credit score people who be, they want to see installment loans. They want to see revolving loans like credit cards. Installment would be more like a car payment, a house payment, something that you pay continually, student loans, something like that. They want to see different types of these loans as opposed to, I only have credit cards. If you only have credit cards, your credit mix isn't going to be as good as someone who has a car loan and a mortgage and a credit card. And that sounds counterintuitive. Again, I'm not saying this is the right thing. And I wouldn't advocate go out and create extra loans for yourself, but it is something to keep in mind. And it is 10%. It's the same amount as new credit. It's those two are the lowest percentage categories that contribute to your score, but it is an important one.
Yeah. And, there is also, I'm glad you brought that up. And thanks again for reeling me in there before I jumped to the next topic. But there is sometimes that myth out there too where rent payments can help. I have heard mixed results, and sometimes a landlord will report that, other times they won't. I've also heard that you can have or like pay for a credit reporting bureau to add those payments to your credit history. So if that's something where like that's your only form of being able to have some credit history, maybe you don't have a credit card, don't have a car loan, something like that, it might be something that's worth looking into. But I just give the caveat that results may vary on that.
Yeah, good point.
That's a big question. It's just on Google all the time. So,
Yeah.
yeah. Well, anyways, let's jump again to like some things to think about when improving your credit score. I think there's a couple of really easy, like low hanging fruit. Right? Make sure that you pay your bills on time. Should be
That's the biggest one.
pretty simple. Even if you can't make the full payment, at least make some form of a payment that's that minimum payment or higher. Well, A, to avoid late fees, but B, to keep that payment history intact. Don't apply for too many loans too frequently, and if you get denied, I wouldn't go try a bunch of other times. It's like this circle of demise that you're going to send yourself down, where they're just going to start looking at all these declines and uh, wonder why the heck is he getting declined so much, right? Any other like easy low hanging fruit that
I
you'd see,
mentioned
Elliot?
it, but I just want to bring it out again. Paying off your credit card throughout the month can be a huge one, particularly if you get a lower amount of credit available. Like, let's say you first apply for a credit card and it only allows you to get, say, $4,000. Some banks are stingy like that, even if you have a super high income.
Yeah,
You don't want to necessarily spend $3,000 on that and have a 75% credit utilization ratio. Pay that off so you get to that 10% or so.
yeah, yeah. I love that. It's a great tip. I think another one too is closing accounts you don't use in a particular order. And this is kind of a bonus tip, but especially if you're just getting started out, like I know credit card rewards, and those deserve their own episode for sure. I know they can be really alluring to people who are getting a credit card for the first time, but I would typically suggest starting out with a no fee or a very low fee credit card to start, because that, like Elliott said, that's the one that's going to be one of your longest credit histories at some point in time. And if the benefits aren't quite what you want anymore, or maybe there's some new fancy card out there with benefits that you like you're not going to want to carry like that 195, sometimes $495 a year annual fee, like if there's benefits that you're not using or don't want. So I think, again, like starting with something that's low fee or zero fee is really smart, because that's the card that you're going to want to carry for a long time.
Definitely.
Yeah.
That's what I have for low hanging fruit.
Oh, okay. I was also going to say, like on the utilization side, or like average length of credit, right? Typically, you're going to want to cancel your newest, lowest available balance cards first, because you're going to, right? If you take the reverse of what Elliott said earlier, if you have a 10 and a 1 and you cancel the 1, now your average credit length is going to go up. But on the flip side too, right? If you have that utilization factor, how much credit you have left to spend versus what you have total, by closing the lower available balance card, you're not going to impact that quite as much if you are carrying a balance or aren't paying it off before the end of the month, like Elliott suggested.
Great.
Yeah. Any other final tips, tricks, wisdom on the credit
That's all I've
cards?
got, I think.
Yeah. They're great tools. That can be a great tool, but you got to make sure it fits into your plan for sure. So
Definitely.
awesome. Well, it was a pleasure chatting with you on this one today, Elliott.
Good. Thanks, Matt.